Move your account to Interactive Brokers and start earning interest.
Interactive Brokers, direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
AB InBev makes a second attempt at a listing in Hong Kong. The world's largest brewer gets set to raise $5 billion as it launches its IPO today. The company sells 1 of every 4 beers around the world and is set to become the world's second largest IPO this year after Uber's $8.1 billion listing.
Today, the Royal Commission in Papua New Guinea is slated to begin with UBS and Oil Search in the spotlight over a $1 billion loan that was issued by UBS to the Papuan government to buy shares in Oil Search. This was a transaction that ended up costing the Papuans around $400 million in losses. On the macro side, though, we've got Q2 house prices coming through, plus the RBA meeting minutes for September. Rate watchers are going to be closely looking for any kind of signs ahead of a live October meeting.
The Federal Reserve Board of Governors gather for a 2-day meeting on interest rates in July. The group cut interest rates for the first time in more than a decade. We get the latest industrial production numbers for August and the latest on how home builders are feeling about the economy with the National Association of Home Builders survey for September. We also get earnings from Cracker Barrel, Adobe, Chewy, and FedEx. Deloitte releases its forecast for holiday sales, and reviewers release their assessments on the new iPhone 11s. New York State Department of Health will vote on whether to ban e-cigarettes.
Interactive Brokers, direct market access to stocks, options, futures, forex, bonds and ETFs. One world, one account.
Interactive Brokers charges 3.63% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 8.07% at Fidelity or Schwab to as high as 8.75 to 9.25% at Ameritrade or E-Trade. Move your account to Interactive Brokers and save at least $4,400, or much more if you're trading big bucks.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch, Tuesday to Saturday.
The Stone Conference is incredibly important to CNBC viewers. We follow the biggest hedge fund managers. This is a place where they all convene. CNBC has the exclusive right to be here. As soon as someone makes a pick, the market will move instantaneously, and then we will be immediately on television, online. You can see here the stock has declined quite significantly today as his presentation went on. The picks are tracked and followed for years to come.
Investors, when they come to CNBC, want to know not just what just happened, but what it means. My role is really to illuminate market trends.
The story for the year has been, if there's one jolt to one part of the market, it gets buffered by something else.
The market is a mechanism for processing all the world's information all the time, constantly. It's really about what it means for what's happening in the world. CNBC is our window on the markets, and markets are our window on the economy.
Good morning, everybody. 7 a.m. here in Singapore, 8 a.m. in Tokyo. Let's give you some headlines. President Trump says the U.S. has reached a trade deal with Japan and that an agreement will come in weeks. But the EU says it expects U.S. tariffs soon after both sides failed to resolve their trade dispute. And Moody's puts Hong Kong's ratings outlook on negative watch after months of unrest.
Good morning and welcome back to Squawk Box. Let's get you up to speed on what you can expect from the trading day in this part of the world. The Japanese markets will start trade at the top of the hour. Remember, they are coming back from a long holiday weekend, so we will be watching for reaction, not just playing catch-up here a little bit to the news around Saudi Arabia and the attacks on the oil facilities, which did weigh on U.S. equities. In fact, the Dow breaking an 8-day winning streak overnight. The losses, though, pretty modest, just off some 0.5% for the Dow at least. But also, Trump's announcement just in the last hour that the U.S. has resolved its trade issues with Japan and is expecting a deal to be formally announced rather soon. So you are looking at Nikkei futures here, indicating an open of 21,815. So you're looking at some downside expected from the previous close going back to last week of 21,988, about 170 points to the downside. But as mentioned, that could be more of a reaction to the negative moves on Wall Street overnight. Let's give you a check here on the U.S. dollar and the Japanese yen. We did see a little bit of a move into safe havens when we first had that news out of Saudi Arabia, although the moves were not as extreme as you might expect yesterday on Wall Street. And now the U.S. dollar still holding above that 108 level at 108.11. As it pertains to the equity markets already open for business, let's show you New Zealand, which is currently trading with a little bit of upside here, higher by 0.2%. And the Australian market will open in just about an hour. You're looking at SPY futures indicating a softer open with about 0.2% to the downside expected. And the Aussie dollar holding at 0.6868. We did have some disappointing data out of China we'll tell you about a little bit later on, both on industrial production and retail sales as well. Shri.
Nancy, Britain, Russia and China are reserving judgment over the Aramco attacks, saying it's still unclear who was behind it. Yemen's Houthi rebels have claimed responsibility, but the U.S. maintains it was Iran that led the move. Eamon Javers has more.
President Trump on Monday all but accused Iran of participating in that strike on the oil facility in Saudi Arabia over the weekend, but the president was careful not to specifically and formally accuse Iran of having taken part in the attack. The president suggested that the United States is continuing to review intelligence information and to talk with its partners in the region before coming up with what he called a definitive determination about who was responsible for the attack that has affected world oil markets. The president also said he's not concerned with the spike in oil prices that we saw on Monday.
We have these strategic oil reserves, which are massive, and we can release a little bit of that. Other countries can be a little bit more generous with the oil, and you'd bring it right down. So, no, that's not a problem. It went up $5, and that is not a problem.
The president suggested he's talking to allies in the region and in Europe, as well as considering possible military options. The president says he's not a person who wants war, but sometimes you are forced into that option. So not clear here from the White House's perspective about what the next steps may be. The president said he might make a statement or he might not make any statement later this week, depending on what the findings end up being. For CNBC Business News, I'm Eamon Javers at the White House.
Any sudden reduction in oil supply is likely to hit Asian oil import-dependent countries like India. RBI Governor Shaktikanta Das, warning that the massive spike in prices could jeopardize India's current account and fiscal deficit. Governor Das advised patience on the oil price and said the RBI would monitor how the supply situation plays out in the next few days to see if alternative sources would emerge. Right, let's bring in our guest host now. I'm very pleased to say that Taimur Baig, a chief economist and managing director of DBS Group Research, is with us. Taimur, very good morning. Let's start with India. And let me ask you this. At what price point does oil start to become a challenge from a growth point of view for India, and what point does it become fiscally challenging as well?
We'd have to go to the 70s and 80s, Shri. If you're going to have oil-related supply shocks, this is a pretty good time to have it. Globally speaking, there is a supply glut. Even Saudi Arabia has substantial excess capacity. Oil prices have been meandering in the 50s for the most of this year. And as recently as last week, we saw the IEA talk about very lackluster demand going into 2020. So 5%, 10%, 15% upside from these extremely low levels is manageable, even for a country like India, which is basically the third largest importer of oil in the world.
But $80 plus on a sustained basis would start to become destabilizing for India.
Absolutely, but that would require significant additional escalation and setbacks in the Middle East. We're talking about retaliation by the U.S. or the Israelis or the Saudis or all of the above on Iran and counterstrike, major supply disruption. I really don't think any of those things are in the drawing board at all at this moment. But if things were to escalate, you would need serious disruption to supply capacities among the major producers before that becomes an issue.
And I think this is really important, Tamer, because we're also talking about the rise in oil with China, too, and what it means for their manufacturing and industrial sector, given the slowdown is already underway. But you make a really good point here. Like, we had this huge surge on a percentage basis, but still in the 60s compared to where we have been previously. This is not going to be a dramatic shock to the economy as of now, is it?
Not with what we have right now. We would need significant additional escalation. The temporary setback in Saudi supply is very much mendable by strategic reserves, not just in the U.S., but also in Saudi Arabia, and excess capacity elsewhere.
But isn't it the delta and the pace of the move that catches the central banks and the policymakers off guard here? Isn't that going to be a problem from muddying inflationary expectations? And from the RBI's perspective, Tamer, are they going to look through this one?
Given where we stand in the growth inflation nexus worldwide, I think just about every central bank out there would look through this. Unless you're sitting in Argentina or Turkey where underlying inflation is an issue, elsewhere in the world, even if 5, 10, 15% upside on oil is not going to make any material difference as far as the inflation target is concerned. So again, if we're going to work with just what happened over the weekend, I really don't think it complicates central banking at all. But, you know, 60s, 70s, then 80s, it becomes an issue. But mind you, when you have exceptionally high oil prices, typically it is accompanied by good demand. We're not in that place at all. I mean, we were talking about China a second ago, and I'm sure at some point in this program we'll talk about Chinese data that came out yesterday. Demand side is so weak that it's going to take a lot
and higher oil could even compound that, right?
Yes, indeed. Definitely the expectation side. I mean, manufacturing is beleaguered worldwide. Domestic demand is holding up in most places given the low inflation, low interest rate backdrop.
Tamer, let's talk about that data out of China, because many were quick to say this could be evidence that the central bank measures, the stimulus measures put in so far, perhaps aren't having their intended effect. Do you agree?
No, I think that's a premature point, because all the central bank easing have not even worked through the system yet. The triple cut measures are phased. We have seen lending pick up in recent months. Broad money growth in China is not abysmal as we see in elsewhere where deflation, depression types of tendencies take place. So I don't think the set of data that we have seen in China so far this year suggests to us beyond manufacturing there is deep malaise or ineffective policy transmission.
I do wonder what the Fed is thinking, though, when they see this data print coming out of Beijing, because, sure, they're preoccupied with whether or not we're going to get even an interim trade deal between China and the U.S., but in the meantime, they have to look at that slowdown in China and worry about the spillover effects, don't they?
Right, but as we have seen in the last, say, 3 or 4 months of data, Chinese slowdown is very gradual. It is not ever having a seismic impact on global markets where the disappointments are so big that it leads to basically a major sell down of Chinese assets. Right. Chinese assets, you know, have not been greatly loved globally, but at the same time, we have seen some support for the fixed income side and certainly on the credit side.
So let me just clarify, Tamer, an oil shock and any associated demand shock is not your base case.
No, Shri, and again, because we're starting with a very low base, I would not constitute a 10-15% upside from where we were last week as a shock. I would say a 20-25% shock upside would be required before we can call it a shock. And in the past, we have seen, we know what the elasticities in the region are. If demand is pretty strong, if you have a 10% swing in oil, that leads to, for the oil importers, 0.1, 0.2% downside for their fiscal balances. Manageable, not a problem.
Does it affect the calculus for the Fed this week?
I don't think so. To the extent that there are doves in the Fed who think that global economic slowdown should be an explicit consideration in Fed decision-making, their minds were made up 2 weeks ago. For the ones who are sitting on the fences, I don't think the Saudi-China data or Saudi development China data change their minds. They will still look at what's happening with compensation, what's happening with unit labor costs, and feel compelled to be on the sidelines. So I don't think this is a event that pushes people on the margin.
Tamer, do you think there's any room still for Fed surprise in the way that they don't move? on rates here, because they may be looking at the strong data in the U.S. still, also maybe taking note of the change we've seen in U.S. bond markets as well.
So Nancy, when you look at Bureau of Labor Statistics productivity report that spans the first 2 quarters of this year, under normal circumstances, that should be ringing alarm bells for the hawks in the world. On a Q&Q seasonally adjusted basis, compensation rose by 9.5% in the first quarter, and on top of that, we had close to 3% jump in the second quarter. But we live in a world where Phillips curve considerations are gone. Just because there is strong wage growth, we don't believe there's inflation. And hence, like I said, the hawks will see that as cooperation. The doves will ignore it entirely.
Should we worry about inflation?
Not yet, probably. But at the same time, if the Fed's imperative is to have a stable wage-price nexus, how can they ignore that?
Tamer, so much to discuss with you throughout the show. Thank you so much for being here, and we're out the hour. And still to come in the program, we will be discussing how the Hong Kong protests have ravaged the city's economy as Moody's downgrades its outlook on Hong Kong to negative. Squawk will be right back.
Good morning, Mrs. Wong.
Good morning. Your favorite.
Thank you. Good morning, Mrs. Wong.
Good morning. Look what I made for you.
Thank you. Mrs. Wong? Help! Help!
Good thing your grandson was around when you had your fall, Mrs. Wong.
Big names, actionable insight at Delivering Alpha. Trade war, the economy, investment opportunities. Wall-to-wall coverage begins Thursday, 6 p.m. on Squawk Box.
A pioneer professor in computer science and AI.
This field has a severe lack of women, and this will impact the technology.
Believing that the technology can change the world.
We create technology to help people, to make lives better. I hope that the future we create is human-centered and it's benevolent.